welcome back to the Notary News Channel. My name is Desiree Roman Rodriguez, and I'm a subject matter expert in all things notary in the state of Illinois. And I'm also an enrolled agent who is credentialed by the IRS to prepare taxes and represent taxpayers before the IRS. This week, we're going to be talking about a second part of taxes and your business, either as a notary signing agent, or a small business owner. So the first thing I want to be able to talk about is the deductions. Now, in last week's session, we talked about not all deductions can be available to each person. It depends what kind of work you're doing, and it also is going to depend on what expenses you have. And then of course the 2018 tax law changes impacts that as well. There are certain expenses that the IRS expects to appear on your tax return, which would be considered normal expenses required to do the business that you're doing. So vehicle is going to be one of them. It's going to actually be a major deduction for the person who is doing a notary or signing agent business, or any other kind of business that's not a stay-at-home business. Another deduction is also going to be your supplies, office supplies, your toner, your paper, tools that you need for when you're in your vehicle. So if you need a GPS, if you need a phone holder, if you need a car charger, those kinds of things would be deductible. It would fall under office supplies. And then of course, if you haven't already purchased your equipment would be another deduction of supplies that you would have. Now, in order for you to know whether or not there's a bunch of other deductions, obviously you would work with your enrolled agent or your tax preparer, but essentially you also are going to have deductions that's not going to be directly an office supply or directly related to your vehicle. So for example, your cell phone bill every month. You need to have the phone in order to get business, talk to clients, accept assignments and appointments. If you only have one cell phone, then you can't deduct the full amount of your cell phone for your business. And the reason is, unless you have a separate phone line or a separate cell phone, then the IRS is going to make the assumption that you're using your cell phone for personal. So in that case, you would not be able to deduct the full expense of your cell phone bill. You would only be able to deduct a majority of it. And you would have to gauge 75% would be for business, 25% would be personal. Another expense would be the internet. So your internet, you would need to be able to have to receive your documents, to email your documents, confirm appointments, print up directions, print up the documents themselves, fax back if you're using your internet to fax your documents back. And so obviously internet's going to be another big deduction. You also have to be careful to deduct out of that expense your cable for watching TV. That's not going to be essential for you doing the job you need to do. So if you have a bundled or rolled in package, you want to make sure that you are only making the deduction for the actual expense for the internet. Other things, and one of the biggest deductions is going to be a home office. Oftentimes, there are taxpayers who think, well, I rent an apartment, so I can't do a home office deduction because I don't own my home and I have to pay rent. And that's a misconception. You can deduct home office deduction if you are a renter. You just have to make sure, and that even this is even true if you are a homeowner, you have to have a dedicated space in your home or your apartment that would be just for your office work. So if you have a one-bedroom apartment and you have a really large dining room, and you have 4x4 of your 8x4 dining area is set aside just for you to do your work, you have your desk and your computer and your printer set up there, then that is the amount of space that you would indicate is set just for your home office. Now, if you have a home and you have 2 or 3 bedrooms and you decide to make one of the bedrooms your home office, In order for you to claim the entire bedroom as home office deduction, you cannot have anything else in that bedroom other than your office equipment. If you put a playpen in there so that you can watch your child while you're working in your office, then that will not be counted as a home office. It will be also counted as a play area for your child. So if you're going to have a bedroom that you're going to use as a home office, it must be a strictly home office. Only the area dedicated to where your desk and computer space would only be what you would be able to deduct. Now, the way that that deduction is figured is it's always going to be a percentage. So when you're working with your tax preparer, they're going to ask you what is the square footage of the entire space that you live in versus the square footage of the space that you have dedicated to your office. And then your deduction will be based on that percentage, on that ratio. The things that you can include in that home office deduction would be things like your gas bill, your electric bill, your water trash bill, if you pay homeowners association dues, if you have a landscaper that comes and maintains the lawn, all of those things would count. So, and then working with your tax practitioner will let you know whether or not you have expenses or deductions that can be classified as an asset and then amortize over a certain amount of time, or whether you want to take the deduction all in one time. So again, working with an enrolled agent or a tax practitioner would be the best person to make those kinds of decisions with you. There are only two types of deductions you can do with your vehicle. You can either do mileage or you can do actual costs. You cannot do both. And also, you cannot switch back and forth from one year doing mileage to the next year doing actual costs. That is not allowed. However, if you introduce a new vehicle in any tax year and you use one vehicle for half the year and you use a different vehicle for the other half of the year, and you wanted to switch from mileage to expenses or vice versa, that you can do. But once you make the decision to either do mileage on your vehicle or to do actual expenses, you have to stick with that decision for the life of the asset as long as it's in the business. Now, how do you determine what would be best for you? Well, for people who have electric or hybrid cars, the best bet will likely be doing mileage because your expenses will be minimal since hybrids are typically newer cars. So if you have a newer car, you're going to want to go with mileage because you're not going to have a lot of actual out-of-pocket expenses. And usually if you're buying a new car, it's going to come with some warranties and some maintenance packages. And so you're not going to have a lot of out-of-pocket costs. But if you have an older car, so let's say your car is at least 5 years old, you just finished paying it off, that's going to be about the time that your car is going to start needing to have its original parts replaced. And in that case, you're going to find you're going to be spending a lot more money repairing. And so for a situation like that, if you have an older vehicle, you're going to want to do actual expenses. If you have a newer vehicle, you're going to want to go with mileage. If you're doing mileage, the only other two things that you can deduct along with your mileage will be tolls and parking. That's it. You're not able to deduct interest and car insurance and the registration fees or city stickers or anything like that. So you want to make sure when you're looking at, jumping into this business, or you're already in this business, if you're buying a car, you're buying a used car, a certified used car, or a new car, all of those options of the type of car that you're buying does make a difference in how you want to set up your deductions. So the next thing is going to be your self-employment tax. So self-employment tax, as discussed last week, you have to pay your self-employment tax because you don't have an employer who pays half, and then as an employee you pay half. So you pay the full 15.3%, which essentially is paying your Social Security and your Medicare tax, so that when you retire, you are able to collect because you've made the contributions to Social Security and Medicare. So it's important to make sure that you are paying those taxes so that that benefit is there for you when you're done being a signing agent or a notary. Now, the self-employment taxes should be paid quarterly. so that it's not all, you're not all hit with it all at one time at the end of the year. The way that you are able to avoid paying self-employment tax is if you incorporate. So if you become an LLC or you become an S corp or a C corp, then your business would issue you a W-2 for any wages the business pays you. And then in that situation, you would have 7.5% of your uh, wages taxes withheld. Your business would withhold those taxes from you, and then the business itself pays the other 7.5%, and then that gets sent off, and then you're not paying self-employment tax in that way, in that regard. So you would have to make sure to set up your business, make sure that you're making those payments and those deductions, and then your incorporated business would then make those tax payments on behalf of the business. So that's one way to eliminate self-employment tax off of your Schedule C. Other than that way, there is no other way to get around your self-employment tax other than the fact that you have no profit, then you would pay no tax. um, One of the other things about doing your own business and is keeping track of your expenses. And as a sole proprietor, the IRS is a little bit more lenient with commingling of funds, meaning you're using your personal bank account for paying the expenses of the business. If you become an LLC or S Corp or C Corp, there isn't any commingling of any funds. You must set up a separate bank account to track your income and expenses, and all of those income and expenses must flow through that business bank account. Still, as a sole proprietor, and even though it's going in and out of your personal checking account, you still want to make sure that you are keeping a very good track of what expenses are personal versus what expenses are business. And that's because you want to be able to show a profit. You want to be able to have a profit and loss statement at the end of the year, so that way you get an overall picture that shows if the business you're doing is profitable for you and if it's something that you should continue to do. And having a bank account instead of paying cash, one, provides you receipts so that you should have evidence to show you had those expenses and you are eligible to take those deductions of those expenses. But it also helps you keep track of your earnings and your profit, and that's also going to be essential if you are buying a home or refinancing your house and you tell the bank, I'm a sole proprietor, I'm running this notary signing agent business. They're going to want to see your profit and loss statement. So even as a sole proprietor, accounting and being able to do accounting or being able to hire someone to do the accounting for you is going to be essential. And running all of your expenses through a bank account or through one credit card is going to be, one, easier to track your expenses, and two, less work for an accountant to charge you. So do yourself a favor, minimize where all the places that you're making expenses, use one bank account or use one credit card for all of your expenses. Now, finally, the last thing, just to kind of give you a round numbers estimate of how you can figure out what your tax situation will be. So, based on one of the comments that was from last week's posting, the net income they wanted to use was $4,000. So for $4,000, let's just say on average you're getting $4,000 a year, and $4,000 a month, and at the end of the year it equals $48,000. So how do you know what the tax situation is going to be? Well, let's then just estimate that you had about $8,000 in deductions. So that those deductions come off the top of that income. So the 48,000 now becomes 40,000. So 40,000 is now where your tax begins after your deductions. So if you're a single person and you're not a head of household, it would be $12,000 off of the 40,000. So then that's going to reduce your taxable income to 28,000. So right off the bat, the tax on that 28,000 is going to be $2,800. So that's the tax that you would have to pay on the $28,000 that you earned, less your deductions for your expenses, less your standard deduction. And then For your self-employment tax, it's going to be 15.3% of the $28,000, which is roughly a little bit over $4,200. So you're looking overall a little bit over $7,000 that you're going to owe for taxes, income tax, and self-employment tax. And again, remember, the self-employment tax is your Social Security and your Medicare. So that $7,000 is a rough estimate of what tax you would need to set aside throughout the year to pay for those two things. And ideally, you should be making your payments quarterly. So what is the quarterly payment? So the IRS has set 4 dates for you to send in a payment based on your earnings that quarter. So for $7,000, if we're going to estimate based on 48,000 a year, you're looking at about $1,750 of a payment for taxes every quarter. And those quarters is April 15th, June 15th, September 15th, and January 15th of the following year. This is going to be it for this week's tax session. We may do some more tax sessions in the future, but that's going to be it for this week. So if you have any questions you would like to see answered going forward, please post them in the comments below, or you can send an email to info@romanendeavors.com, or you can shoot us a tweet at Notary Channel on Twitter. Thank you for watching, and don't forget to subscribe below. Have a great day.